Well, back with first trades right here in ET now, and despite a modest rebound in the benchmark indexes since the West Asia crisis, the primary market activity has clearly remained subdued all through the month of April, reflecting a very cautious issuer and investor sentiment. In fact, Ashesha is here from our research desk with more insights on the same.
Primary market action has been fading over the last few quarters, and there is evidence to prove that. Let's first talk about the number of issuances and the amount of money that has been raised over the last few quarters. There were 50 issues in third quarter of calendar year 2025 and 39,880 crore. That's the quantum of amount that was raised via primary market action. In the fourth quarter, number of issuances declined from 50 in the previous quarter to just 29. In the first quarter of 2026, that's calendar year 2026, we've just seen about 18 new issues totaling to about 18,800 odd crores. And in the month of April, it has been even worse. That's of course because of West Asia crisis and the kind of decline that we have seen in equity markets. The sentiment clearly has slowed down, and that is the reason the number of issuances and the amount of money raised has gradually declined in the month of April further. Now, there are some companies which have received SEBI approval, but listing is awaited. Perhaps they are waiting for the right time to get listed on the bourses to get the correct valuation. Hero MotoCorp, they received approval in May, and they are estimating about 3,600 crores of IPO. Greaves Electric, it received approval in May 2025, about 1,000 crores of IPO. And Credella Financial also is looking to raise about 5,000 odd crores via the primary market. So clearly we have seen a couple of companies where they've received SEBI approval, but they are waiting for the right time to come up with their IPO. Hero Motors, Orient Cables and Runwal Developers are a couple of other companies which received SEBI approval in calendar year 2025, and they are waiting to get listed for the right kind of valuation. Now, all such companies total to about 149. This is the data that we have curated from Prime Database. 149 companies have received SEBI approval, but they are waiting for their listing, which means 2.15 lakh crore rupees. That's the amount of money that could be sucked in via the primary market over the next few quarters. Let's also talk about a couple of other companies which have not received SEBI approval. They have made an application, but the approval is yet to come. We have PhonePe. It made an application in September 2025. It is looking to raise about 11,700 odd crores. Zepto looking to raise 11,000 crores. It has made an application in January this year. And SBI Mutual Fund, about 13,000 crores of money is what it is looking to raise. So several companies which have made an application, but SEBI approval is pending. About 82 companies are awaiting green light, totaling to about 1.74 lakh crore rupees. So yes, clearly we have seen primary action fading over the last few months, and several companies have received approval, but they are waiting for the right time to get listed on the bourses.
Okay, that's primary action. While it faded in April, it seems like things are finally looking up. But let's address more earnings, and we've got Brigade Enterprises, another set. It's been an overall weak set from them. Let's try and analyze and dig deeper. We've got Pavitra Shankar, the MD, joining in on the show right now. Pavitra, hi, morning. Welcome to ET Now. Just going through your numbers, Pavitra, it's been a weak quarter for you. The full year pre-sales as well have seen a little bit of a dip of about 6%. Tell me what went behind the performance in the quarter gone by.
Sure. Actually, in terms of the quarter gone by, it was a pretty strong quarter. In terms of we did sell 2 million square feet with over 2,500 crores in booking value. For us, in terms of the full year, we did see a delay in many of our approvals, and that is predominantly the reason why our annual numbers saw a bit of a dip. But in terms of realization, which is the average realization per square foot, we still were able to show an increase of around 13% year over year. So in general, the trends are good. We did have a heavy dependency on launches, which is something we had been talking about in the previous quarters as well. But we do see demand on ground to be still pretty good. And we're confident that with the launch pipeline coming through, we should be able to continue to show good numbers. So really, it was a timing difference for us on the financial year, but quarterly, we were able to do pretty well in terms of overall numbers.
Okay. Pavitra, hi, morning. Can you give us a sense on what the forecast would be for pre-sales in FY27? And other than residential also, how are you expecting the commercial segment to shape up in FY27?
So on the commercial segment and hospitality, of course, both have done very well over the last year in terms of showing revenue growth and EBITDA growth. In the coming year also, we expect to see the office market do pretty well. There is, despite all of the conversations going on, there is still good appetite for leasing, and in terms of absorption, numbers have been good, especially in our target markets of Bangalore, Chennai, and Hyderabad. On the residential side, yes, we do want to grow substantially. Our typical, estimate is to grow 15% year over year. While we did miss that over the last year, we are gunning for a substantial increase. Again, a lot of dependencies on the geopolitical scenario and also on what domestically the oil prices and fuel price situation would be going forward. We are yet to see how that really pans out post all of the elections that have happened.
Okay, so that's your outlook on how FY27 could shape up in terms of pre-sales, but also talk to us about your launch pipeline. You have announced that you're going to be launching 14 projects across Bengaluru, Chennai, Hyderabad, as well as Mysuru in FY27. Can you tell us what the expected launch timeline is going to be for all of these projects? And if you could give us a rough sense on what the combined GDV is?
Yeah. So in total, it's about 11.5 million square feet of projects across these four markets. While today our inventory and average APR is north of 12,000, the upcoming launch mix, the APRs would be a little more skewed towards mid-segment. So assuming around a 10,000 rupees per square foot APR. So the GDV would also be around 11,500 crores or so. While there are 14 projects, 3 of those are in Mysore, which are fairly small. So of the 11.5 million square feet, 4.5 million of that would be from Bangalore, and another 3 million from Chennai and 3 million from Hyderabad. These are the larger projects that we would be launching in our core markets. And again, we're looking at a similar kind of GDV applying a 10,000 rupees per square foot average value. As similar to the past, we have had a lot of dependency on launches pushing more into H2. We do have visibility for a couple of launches in H1, but again, we are seeing a lot of the launches coming into H2 for the financial year. We, of course, will be pushing to pull up as much as possible so that we can get that visibility for the financial year as well. But we do also have an opening stock of around 7.5 million square feet, which we will be looking to monetize during the coming year also. So both given that we have the opportunity to do that for our sustenance portfolio as well as our launch portfolio, we would be pushing pretty hard to increase our numbers this year from a pre-sales value perspective.
Pavitra, how much would be the execution in this quarter and delivery that you are expecting in FY27?
So in terms of FY27 or in terms of annually, we expect to do a few million square feet every year. So as of now, we have around 100 million square feet of projects. We have around 31 million square feet of projects under construction. So we're looking at doing about a few projects completion every year.
It's rough guidance of how much of delivery in terms of square feet that will happen. I'm looking from a point of view of cash flows, which you're going to recognize as part of the delivery and execution.
Yeah, potentially about 3 to 4 million square feet of completions.
And that would mean in terms of cash flows, how much will you be able to recognize?
I'll have to come back because that is really a mix of what we can actually register in terms of customers coming forward for registrations as well.
Okay. Pavitra, help us understand. You've recently announced a partnership with Bain Capital to develop a premium mixed-use project in Bengaluru. What is the expected revenue and launch timeline of these projects? And are you also looking at further partnerships like these? Is that something that you are actively looking at the moment?
Definitely on the commercial side, for large capex projects, it's great to have a partner, especially quality partners like Bain. We do have an existing portfolio with GIC, so naturally our intention to work with high quality partners is definitely there. We're very happy about this particular project. It is overall an investment of 2,200 crores. It is predominantly an office project with a five-star hotel, a total of around 2 million square feet, and a hotel of we're looking at the design, but probably north of 200 keys in a core part of Bangalore, which is also metro connected. So we're quite positive about this. And as I mentioned, from an investment standpoint, 2,200 crores, and we would look to finance about 50% of that with construction financing.
Okay, so that looks good. Can you also talk to us about what the current pricing environment is and the like-to-like price increase that you're witnessing in Bengaluru as well as the other key cities? Basically, the realization, how is that shaping up?
So I'm assuming on residential. So
Yes.
in our own portfolio, we've seen that grow, on an annual basis, 13%. But some of that is from a product mix as well. So if we're looking like to like, it's more like a 9 to 10% year over year, and that's that's kind of the same regardless of which market we're operating in. So whether it is Bangalore, Chennai, or Hyderabad, we're looking at that kind of range for like to like product.
Okay, and lastly, Pavitra, also in light of the disruption that we've seen in West Asia, are you seeing any slowdown in inquiries coming in from potential buyers? Because we've been speaking with a few players on ground, and most of them have been indicating that demand has taken a little bit of a hit. The sentiment has deteriorated on the back of this West Asia war. Are you seeing something similar play out on ground?
So we're seeing a different mix of inquiries. I'd say there's more inquiries coming in from NRIs in terms of looking at India as an investment option. One, supported by the geopolitical scenario. Two, by the depreciation in the rupee as well. Domestically, also there is I wouldn't say a drop in inquiries, but rather more time taken to close out a transaction. And again, I think we're all pegging towards the last, 3 to 4 years where the market was extremely buoyant. So I think compared to that, we are all seeing there is more time being taken to close the transactions. Supply also is something that most developers have been able to put into the market while there is launch dependency. So customers do have time and do have choice. And that's what we're seeing. But in terms of conversion rates, that is still pretty healthy. So I think it's really just a matter of, managing the expectation in terms of time taken to close a transaction. And, from a lead perspective, I think we're still doing well. There's less of speculation in the market, I would say. So it's going more towards end user demand. So as a result, we may see less of leads coming in from speculative investors.
Understood. Pavitra, great to be speaking with you today. Thanks as always for your candid chat.
Thank you.
Okay, let's take a very quick break. We'll be right back, continue tracking markets on the other side.
Welcome back. You're watching First Trade, and joining us today is Veer Advani, Chairman and Managing Director at Blue Star. Mr. Advani, hi, morning. Can you take us through your operational performance for FY26, and how do you see the next 1 quarter coming up because of the early summers?
Hi, good morning. Thank you for having me. Q4 for us was better than the full year. We started the year slow because of a washed out summer, but we're able to recover in Q4 somewhat. You may have seen that while revenue was only up about 1% to 4,072 crores, EBITDA grew by 17% to 326 crores. Again, a mixed performance between our UCP business, our room AC business versus the projects business. The room air conditioner business and commercial refrigeration, while we did not have volume growth, we were able to do a much better EBIT than we had expected. Our EBIT margin came in at 10.4% for the quarter. That was largely on the back of price increases, as well as some operating cost efficiency that we took out. As far as segment one is concerned, which is our projects business, while again it was a flat quarter for volume, a slight dip in EBIT, largely on account of certain change in business mix. So we had a higher share of infrastructure projects being built in the quarter, but outlook for both segments looks very positive right now.
Veer, does that change now, given that summer demand appears to be recovering from mid-April? It's a hotter than ever summer. How do early season trends compare versus last year? And does this support a stronger full-year outlook for room ACs in particular?
Thanks. So, it's somewhat of a complex situation. So on the one side, you would have seen March was a washed out month, which is why, we didn't see volume growth over Q4 of the previous year, which is a very big quarter. But then the summer is set in by the 15th of April, which is very good for the industry. There's a lot of inventory in the industry that we entered into in April. So a lot of that tertiary sale has picked up in the second half of April, and it continues to be strong in May. Primary sales, of course, while they picked up in April, we expect much stronger May primary sales as inventory gets cleared out in the field. So, of course, we're hoping for an extended summer. We need the summer to last till at least the 15th of June. If it does, then, you'll have a situation where inventory is cleared out, primary sales are good, and, it's been a good season. But a lot depends on the weather right now. You're aware that costs are increasing quite rapidly. We've already had 2 rounds of cost increases. The first one was in January on account of the energy efficiency table change. That was 5%. We then had an 8% increase because of commodities and forex moving pre-war. And now we have the war, which is putting pressure further. So a lot of cost increase coming in, which means prices will go up. It may put a dampener on business in the second half, but looking forward to an okay Q1.
Looking forward to an okay Q1. That's the highlight. Mr. Advani, morning. This is Snehi joining in. Good to be speaking with you. Let's talk about the unitary cooling products. That segment has broken a 3-quarter negative growth streak. Now, in your view, does this mark the beginning of a sustainable recovery, or given the way the weather is, as of now, it's still a little too soon to say?
Hi, Snehi. So, Q4, we had actually hoped for a plus 5%. We only came in at about plus 1, as you saw, basically even. That was largely because of the rains in March. So it's a delayed summer, but fortunately, it's turning out to be a good summer. And so we do hope that volumes pick up in Q1. But like I said, it's a mixed bag because you have this high level of inventory in the field, which is putting pressure on pricing. You've got cost, increases that I've talked about. So it's really about market share versus margin. We're playing a tightrope walk right now. I think we're doing relatively well on both fronts. We held on to our market share on a standalone basis in Q4, in spite of being one of the few brands to increase prices. The others did not. Of course, on the full year basis, last year, we improved our market share slightly to 14.25%. The aim for FY27 is to grow by another 0.5% to take it to 14.75%. But of course, a lot of that depends on how margins play out because of the cost pressure.
Tell me, Veer, how is the premium versus the mass segment demand mix evolving? And which segment is seeing stronger traction?
So, unfortunately or fortunately, the entire market is now mass. There's a very small premium market that's agnostic to the weather, as you know. Ultra HNIs will continue to buy regardless of weather. But the belly of the market is where all the growth is. It is in tier 3, 4, 5 markets like we've been talking about. It is across the length and breadth of the country. The South has picked up a lot faster because the summer set in earlier there. West is obviously hot, we know that. And the North is yet to kick in. The North kicks in later in the summer in any case. So we're looking forward to a strong North recovery as well.
how are you managing the pricing part of it? There is cost pressure which is coming from input side. Are you able to push that price across to the consumers?
So far we have, so I told you the cost is up by about 13%, 5 on account of energy table, 8 on account of raw materials and forex. So it's about 13%. We've been able to increase prices by about 8%. So we have not been able to pass on the entire cost increase to the market. And so we are able to manage because volumes at least are picking up. Of course, there's concern that now post-war, the inflationary pressure will be higher. We're already seeing increase in plastics and chemicals, refrigerants. So that increase is yet to hit the industry. I think it'll hit the industry in Q2. And so we'll have to look at further price increases in Q2 as an industry as we go forward.
And Mr. Advani, what would the impact of that be on your volumes? How much more legroom do you have to hike prices without it starting to affect the AC volumes?
Yeah, so that's what I talked about, right? So there's a market share versus margin tightrope we're walking. Of course, in Blue Star, we usually manage both together. We're not only a volume player, only a margin player. This year it's become a little bit more acute, and therefore we're taking calls almost on a daily, weekly basis. Intention is to hold or grow our market share. The real expectation from us is that the overall industry should keep growing, that this cost increase and the inflation that we're feeling, that should not hit demand beyond a point. That's the expectation and hope that we have. So as long as we're able to contain price increases to just under double digits, I think demand should still hold. When it crosses double digits, of course, demand is going to also come under pressure.
Looking at institutional business, especially new upcoming opportunities in the data centers, are these business high margin for you, or there is a huge competition in that business for you?
Yeah, so in segment one, you may have seen while the full year was okay, we had a slightly lower EBIT in segment one, which is our projects business in Q4. Nothing structural there. That was just on account of business mix being different. In Q4, we build a lot more infrastructure projects as compared to data centers and other verticals, but that gets, that's just a quarterly phenomenon. Outlook over there is quite positive. Like we've been talking, huge demand in data centers. So for the full year last year, data centers accounted for just under 10% of the total Blue Star business. And we're expecting that to reach about 15% over the next 2 years. Growth is quite strong there. Margins are better than the rest of the projects business. But of course, there again, there are cost increases. There's a lot of inflationary pressure. So we may not see big expansion in margin in segment one in FY27, but we continue to feel that 7 to 7.5% EBIT is what we can deliver in FY27 on a higher volume on account of data centers and factories.
Okay. And Mr. Advani, lastly, I'm just trying to get a sense of what your overall FY27 growth outlook would be, given that you had guided for a degrowth in FY26 and you've still managed to deliver about 3.6% positive growth on the revenue front on an annualized basis. What's the outlook for FY27?
So obviously we will have growth. There's inflation already there. So just on account of inflation, you'll see growth, but we're also seeing volume growth across all our businesses. And so it should be a good, we're looking at 15+% revenue growth. Of course, we have to look at the margins as we've already discussed. It's a tightrope there, but also hoping to do better in the new year as compared to what we've done in the last year on the margin front.
Interesting. We're great to be speaking with you. Good to have you on the show today. Thank you so much for your time.
Thank you.
Okay, that's a very candid conversation coming in from the management of Blue Star. Stock lower by 3% as we speak right now. For the market as well, it's been quite a U-turn and a bit of a flop, if you will. Look at a Blue Star, look at a Policy Bazaar that's taken a sharp downtick. It's down about 4% right now. Godrej Consumer is down 5%. And so is the case with a KPI D-Tech as well. Other than that, technology and some of the consumption plays are the ones which are weighing heavy on the markets. L&T as well, after starting off in the green, is completely turned tide, as is the case with SBI, and Reliance too, which are weighing heavy on the index as we speak. But we'll wind it up right here on this edition of the Market in First Trades. It's a goodbye from all of us. Hello and welcome. You have tuned into Midcap Masala right here on ET Now. I'm Shrishti Sharma and with me is Ashesha. And viewers, this is the show where we tell you all that is happening within the broader end of the market and also get you the big management voices as well. So let's get started. And firstly, let's have a look at the key headlines of this particular hour. First up is Aptus Value Housing that has shot up 8% on the account of strong Q4 results. The NII was seen at 239 crores versus 216 crores, and that's a jump of 10.5%, and the stock is indeed excited in today's trading session.
Brigade Enterprises falls 3% in trade on the back of weak Q4 results. Revenues have come in at 1,458 crores, a downtick of a marginal 0.2% on a year-on-year basis, but margins have contracted from 28.5% same time last year to 25% now. But remember, the outlook remains positive. The company has 12 million square feet of upcoming projects that are planned to be launched in the next 4 quarters.
And Allied Blenders and Distillers surges after receiving approval to revive its letter of intent and obtain a license. And this is to set up a greenfield IMFL bottling plant in Andhra Pradesh with an annual capacity of approximately 46.5 lakh cases.
Meesho gains in trade were led by narrowing losses. EBITDA loss in the Q4 stood at 255 crore versus a loss of 261 crore that the company reported same time last year.
And Servotech Renewable Power System is up 2% on 1,415 kilowatt of solar rooftop project order from Vijayawada division of South Central Railway.
Shipping Corporation of India surges 10% in trade on the back of signing an MOU with NBCC for upgradation and renovation of the Maritime Training Institute in Powai, which is an asset that is owned by Shipping Corporation of India Land and Assets Limited.
And Midwest Limited rallies 6% on the back of being selected as the lead consortium partner by Kerala Minerals and Metals Limited to develop a strategic pilot plant. And on to the Midcap Masala show. Let's get started with talking to the management. And today we have Bajaj Auto management with us. The company did come out with a very good set of earnings, and not just that, they are bullish on the export front. They've also announced a buyback, and lots been happening. So let's understand all of that in detail. And we are being joined by Mr. Rakesh Sharma of Bajaj Auto on the show. And Rakesh, I'll not read out your designation because I want to congratulate you for taking a bigger leadership role at Bajaj Auto in the times ahead, and that's indeed big.
Thank you very much, Srishti. Very nice of you to say so.
Absolutely. And Rakesh, lots been happening at Bajaj Auto, and you and your team have been working well. And let me start with the EV side of the business, because you guys have gained market share, especially in the last year. We have seen that turnaround happening. But in the con call yesterday, you have highlighted that the demand is exceeding supply for Chetak EV. So firstly, help us understand what are the plans to ramp up the production for Chetak? What sort of a capex that you will be looking going ahead, and with Chetak now being exported, what is the kind of volumes you are looking at when it comes to the overseas market?
Yeah, Shristi, first of all, in the current scenario, we are again seeing a lot of consumer sentiment driving the EV side of things, not just in two-wheelers, but also in three-wheelers. The EV growths are far outpacing the ICE growth in their respective segments. And as you mentioned, we are started to do pretty well and very, very consistently. Our portfolio in Chetak has expanded, and those new introductions have been accepted very well. So we are very optimistic about how things unfold here onwards. Our capacity in Chetak is about 50,000 units, but of course there are within that there are sometimes constraints given the kind of depending on the product group one is looking at. We are testing that capacity already, and we definitely think there is a need to expand that capacity. We have all the infrastructure, as you know, and we are right now actually working out plans to substantially expand the capacity. The three-wheeler side also is getting tested. We have noticed that there is a greater bent towards larger three-wheelers, because not just electric, but larger body three-wheelers. And because these are used for slightly longer distance, carrying passengers over longer distance in a shared taxi format. And there again, our capacity is being tested, and we are looking at plans to unlock capacities well in time, in both of them, well in time for the season, which of course is in October, November, and which should see a surge during that time.
As far as the fourth quarter results are concerned. Mr. Sharma, morning, Ashesha this side, and congratulations on your new role. Wanted your thoughts on volume growth in FY27 as far as the motorcycle segment is concerned. You reported strong growth of about 20% in the fourth quarter. You're expecting about 7 to 9% in the first few months and first few quarters of FY27. If you can take us through what will drive this growth and what will the levers be?
Thank you very much, first of all, for your best wishes. So actually, we have seen a de-acceleration in the industry. Since the GST rate cut, the industry has been really rocking at almost 20% growth levels, and also in quarter four. It's very hazardous to start speculating about future growth. So we tend to look at the more immediate performance of the industry and try to extrapolate that. And we find that in April, for example, the industry de-accelerated to a 9% growth. But of course, there is a base effect over there, because a lot of the season, the Ugadi, Gudi Padwa, the Mini Chair, Navratris, they all got advanced into March, and they were in April last year. So accounting for that base effect, but then weaving in a little bit of the inflation which we are seeing, which is eroding a lot of the price cuts which the consumer experienced after the GST rate announcements. Combining both of these things together, we feel that in the near term, 7 to 9%, or depending on the segment, between 10 to 15% growth. The 150cc segments growing definitely at 1.5 to 2 times the average growth is what we can see. But to sort of speculate about the full year's growth at this point of time, when we don't know how inflation particularly will pan out, both in terms of our own raw material palette, and what the consumer experiences in everyday consumption basket. So we have to really look at that. That is really something which could have a very big impact on both the consumer sentiment and real purchasing power.
All right. But Rakesh, let's talk about your overseas business, because that's heartening to know that your exports continue to do well and you are still sounding so bullish on growing these numbers and at least holding on to that. Give us some sense that which market or which geography do you think will be performing the best in the times ahead, and also any particular category where you want to expand or focus more, because it's not just the premium two-wheelers, it's three-wheelers and now EVs that can play a good role.
Yes, so we are very optimistic about the performance in overseas markets. As you know, we are in 108 countries, but 30 of these countries account for almost 80% of the emerging markets industry. And in these 30 key markets are growing at almost 12 to 15%, which is a very handsome growth. And our growth in these 30 markets collectively is almost 25 to 27%, which shows that we are getting a disproportionate share of the growth. And this is the outcome of work which has been anticipated and done over the last 2-3 years in territories like LATAM, which have done extremely well, Mexico, Central America, Colombia, Peru, Argentina, Brazil. All these countries are performing extremely well. Their currencies have been stable and demand has been very good. Our competitive positions in all of these countries has been very good. And we are particularly enjoying leadership in the sports bike segments, which has a halo effect around the brand. And that's why we remain optimistic. Having said that, our largest market, Nigeria, which is, where we have a 50% market share, which used to be huge. To give you an idea, it used to be, it had even touched 75,000 units in 2022, but it's been a slide due to economic conditions and devaluation over there. But it has stabilized. I think now we can say, at least, if there is no other disruption in the last 3-4 months, we have seen some kind of a equilibrium, and our sales going up from 15,000 units to 25,000 units to now 36,000 units at a trot. Last 2-3 months, we've been at 36,000 units. There too, our competitive position is very good. So we are getting a very good share of the growth because our competitive position arises from a very widespread retail network, which I believe is the widest amongst all players over there. And this allows us to access growth in all parts of Nigeria. We have almost 800 stores that we sell through. And that has given us our ability to maintain, this high level of market share, even while commanding premium. Asia, we find that places like Sri Lanka, Nepal, Philippines, again, areas where Bajaj Auto has got historical and deep strengths, they are coming back, and that has added to the growth. And it is helping us mitigate whatever losses we have seen in the Middle East areas because of the war. The electric side in the exports has just commenced. We have commenced the export of Chetak in 3 countries, Sri Lanka, Nepal, and Philippines. Like I said, these 3 are very strong markets for us. We have done our analysis, and we believe that the consumer will favor the electric option. But this is a phase where we are going to observe how the product is used, what is delighting the customer, what is not, and make those adjustments before we really put our foot on the accelerator. We have also started exports of electric three-wheeler.
Understood. So that's as far as demand is concerned. But Mr. Sharma, another concern for the auto industry is the surge in commodity prices. You've said that you've been only able to absorb 40% of the cost increase. So what are you trying to do? Will you be looking on to pass on the price increase to your consumers, or will that have a hit on your margins? What will it look like?
You're absolutely right. The commodity side has seen a sharp increase of almost 4 to 5% in revenue terms in things driven by things like aluminium, polymers, noble metals, and to some extent even steel. Of course, we have been sensing this since March, and we have taken early action and passed on 40%, not absorbed, but passed on 40% of this for price increases through price increases on 1st of April. One mitigating factor for us is the very high export component which we have. And the realization of the dollar was 88 rupees in the last quarter, and now you know that the dollar is rupees realizing 95 to a dollar, and that helps us to mitigate some of the cost side inflation. The other thing about this is that it's a very dynamic situation. It's not like previous times where one could finalize and lockdown deals which were quarterly or 4-monthly or 6-monthly. The situation is evolving every month. So every month we have to look at how much the costs are increasing. And then, of course, in some markets and some segments, we have to see what will be the impact on demand, how competition is behaving. And I think we will be doing this in a very dynamic manner after taking into consideration all these things, the exchange rate, the realizations, the actual inflation, and competitive behavior, and the impact on demand.
So several factors continue to remain at play, and everything depends on how the West Asia conflict moves. But Mr. Sharma, thank you so much for taking your time out and joining us here on ET Now and sharing your outlook for Bajaj Auto for the next few quarters. Thank you for joining us today.
Thank you very much.
And shifting focus from one corporate to another, then Muthoot Microfin is in focus on the back of results that it reported, and it has reported strong AUM growth in the quarter gone by, which stood at about 14%. That's the kind of growth on AUM front for YOI. What's the outlook going forward? To discuss that, we are now joined by the CEO of the company, Sadaf Saeed, now joining us. Thank you so much for taking your time out. And first up, we have to talk about AUM growth. You've given a guidance of 12 to 15% for FY27. Now, this is muted as compared to what you've reported in the fourth quarter. What factors are leading to a more calibrated growth outlook? If you can take us through that.
No, thank you, first of all, for having me. I think it's important to lay out the context. In a year where the industry has almost degrown by 20%, Muthoot Microfin grew by 13.3%. And in terms of our guidance, we had guided that we will be achieving 14,000 crores of asset under management, and we have stood firm on our guidance, and we have achieved that. I think more important to realize is for a financial services company, there are three key fundamentals. One is your consistent AUM growth, which we have demonstrated with our AUM growth of 13% and reaching 14,000 crores of AUM. The second aspect is asset quality. I think this last year was very, very important for us. We had certain strategies laid out, and they have played out well for our asset quality has improved significantly. From GNP of 4.85%, we have brought that GNP down to 3.89%. So 95 basis point of improvement on GNPA. Net NPA remain very low to 1.2%. So 20 basis point reduction there. And our provision coverage remains strong at 71%. But most heartening fact is that our collection efficiency has improved significantly. Whereas in the last year, same quarter, the collection efficiency was just about 90.6%. It has come to around 96.48%. So almost 575 basis points of improvement. And this is brought about by the strategy that we have adopted of diversifying our asset class. So we have introduced a new product called individual loan. In that business, we have already built 2,300 crores of asset under management, and that's supreme quality. There is zero delinquency there, zero 30 plus. And as of now, the performance of the portfolio is really, really well. I think apart from this, I think for a financial services entity, what is more important is how's the cost of fund. And in the year which has just completed, we have reduced our cost of fund by 75 basis point. Our overall cost of fund for the last financial year was 11.02%. This year, our cost of fund is 10.23%. So that has really helped us to improve our profitability. And if you look at our total contribution to net worth, including the OCI, we have contributed around 217 crores to our net worth. The PAT is 170 crores. There is an OCI component which is there of around 40 crores. So total 217 crores, which we had guided that we will be achieving around 200 crores plus addition to the net worth. So on the guidance front, on the AUM we have achieved. On the credit cost we have achieved. We had guided a credit cost of 4 to 6%. Our credit cost has come down to 3.5%, so which is much better than our guidance. And standalone for the quarter, it has come down to 2.8%. So going forward, I think that is going to play out and improve our ROA. We had guided for an ROA of around 0.5 to 2%. For the standalone quarter, we are at 2.1% ROA. And for the full financial year also, we are at 1.7% ROA. So from that perspective, the company, whatever guidance we had put out, we have achieved. There are certain work in progress, which is in terms of NIM improvement, as I think our newer portfolio that we have originated at a higher yield will continue to accumulate in the book. The weighted average yield on the portfolio will also improve and the NIMs will also improve.
All right. Good morning and great numbers indeed. But just wanted to touch on the NIMS part because since you have been highlighting that is expected to improve. So any number in mind that you can help us with? What is the target on that front? And also, since the credit cost has also moderated sharply in Q4, should this be considered as the normalized rate going ahead, or there's a risk of volatility in this number as well?
Yeah, very important. I think on the NIM front, we are guiding around 12.5% NIM in the next financial year and going towards around 13% in the following financial years. And from the asset quality perspective, I think one is the core business, which is the JLG loan that has improved. The collection efficiency there has definitely improved. But our asset quality further is improving because of the portfolio diversification that we are doing. So we have introduced products like individual loan, loan against property, and gold loan. And at the beginning of the year, we had 97% of our book as JLG and 3% as non-JLG. Today, that stands at around 83% JLG, 17% non-JLG. And this is also above our guidance. We have guided for 85-15, but we have achieved more than that. And the portfolio that we have originated this year, around 57% of the book that we are having in our balance sheet today is originated this year. In that portfolio, the asset quality is very good. 30 plus is only 0.8%. So from that perspective, we can say that the steady state asset quality has been achieved, which has been our consistent performance. The credit cost would be for the future would be in the range of 2.5 to 2.75%, which will ensure that we will reach 3 to 3.5% ROA in the coming year.
Right. Also wanted your thoughts on credit costs, which is moderated sharply in the fourth quarter. Should this be considered the normalized run rate going ahead, or are there risks of volatility due to unstructured nature of the portfolio?
So I think this is what we are used to in terms of credit costs. There is further scope of improvement. We guide that in a long-term basis, if you look at the credit cost should be 2.5%. And this is what it has been in the previous year prior to the crisis years. So I think we have already achieved that. And with the diversification strategy that we have put in place, I think this will continue to improve further. But we are guiding towards around 2.5% credit cost. The most important part is the yield will expand in our portfolio. Our yield on the portfolio is around 18.8%. Overall, it will expand to around 200 basis points. So we are likely to cross around 20% in terms of yield. And our cost of funds are coming down. And at the same time, credit cost is also coming down. And then our OPEX is also rationalizing because we are doing more business with the same number of branches or lesser number of branches. Our average outstanding per branch has improved by 1 crore. We were at 7.2 crores. It is now 8.3 crore per branch. Our productivity for field staff has also improved, where one field officer was managing portfolio. Now he's managing around 1.5 crore portfolio. So overall efficiencies are kicking in. Our operating cost, OPEX, has come down from a peak of 7% to 6.4%. This is further likely to reduce in coming years. So definitely, I think from an ROA, ROE perspective, we are likely to see much better performance in coming year, and credit cost will remain within this range of 2.5%.
All right, and we look forward to that. With this, Mr. Said, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you. Thank you very much for having me.
All right, but with this, viewers, we are completely timed out in this edition of Mid Cap Masala. It's a goodbye from me and Ashesha and the entire team who put the show together. Thank you so much for tuning in, but don't go anywhere. Bye now. Till now, we'll take the action.